welcome back. Let's head back to the Ambit India Access Conference in Singapore. D. Arulselvan, the Executive Vice President of Cholamandalam Finance, joins us now. Mr. Selvan, thanks so much for joining us on the show. I want to start by asking you your view on the liquidity crunch, because the expectation is that credit growth for NBFCs will take a hit and disbursements could remain muted over the next couple of quarters because of the crisis. But your own assessment?
Thanks for this opportunity to talk to you. My assessment is, yes, there is a liquidity crunch, but I think it will be more pronounced for NBFCs and HFCs who have a lower credit rating and who have a lower credit standing in the investing community. I think for organizations like Chola or reputed organizations with a good credit record, I think opportunities to get funding from banks and other investors are good. So there will be no liquidity issue, but of course there can be a pricing issue which could be slightly higher priced because the banks as well as the investing groups are taking advantage of the current situation and pricing up the lending book. But that is something we need to work around with.
Okay. In your own case, what was the share of CPs and how much is it now from, say, a quarter ago?
A quarter ago we were at around 11%. During the last 2 months we have not borrowed significantly on the CPs, so it has now dropped around 7%. Always we keep our CP exposure in the range of around 10 to 12% and CP as well as CC put together, which sort of represents the shorter end of the borrowing, we keep it below the 16 to 17% mark.
So since you have indicated that the festive momentum has been a bit low and growth has slowed down, what kind of disbursement targets are we looking at, say by the end of FY19 and even in the first half of FY20?
See, in FY19 overall full year we are still targeting a growth of around 20 to 25%, while we have clocked a higher growth in the first half because last year's base was lower in the first half. We may not seem to be growing that heavily in the second half because again last year second half was a good year. So the growth as percentage compared to quarter on quarter may seem to be lower, but overall full year we will still be clocking a good amount of growth in the range of around 20 to 25%. FY20 also we see good growth in vehicle finance, especially we see that because we expect preponement of the pre-buying happening because of the BS6 implementation that is scheduled in April 20. So I think manufacturers will slow down production of BS4 vehicles much ahead of the schedule because they would like to clear their inventory before the BS6 launch date happens. So there will be a lot more pre-buying in FY20. So the FY20 also looks robust.
Okay, you said that in the third quarter and the fourth quarter you will be able to reach 25% growth?
For the full year, FY19, our growth will be in the range of around 20 to 25%, yes.
Okay, and will it come at the same margins of 13% or, I mean, what margins will it come at?
See, the yields will improve because we will be doing some amount of price shift of the cost of funds increase to the customer. So there will be yield increases coming through. But overall, while NIMs may be little bit lower than what we had been seeing last year, it will be better than the first 2 quarters, and it will also be compensated by lower OPEX and lower NCL. Our aim is to protect that the ROTA levels are maintained at last year levels.
Okay, so you said 25. You have done actually an average of 30.5 in the first half. So you expect somewhat of a slowdown,
exactly.
probably. Okay.
Exactly.
Okay.
No, that is the result of the base effect last year versus this year. That's what I tried to explain in the beginning.
Okay, just one final question then on the CPs. You said that you've not borrowed in the CP market over the last 2 months, correct? I mean, is that the plan going ahead as well?
No, we will be leveraging the CP segment, but we consciously kept it low because the pricing for CPs were as good as the long-term loans in certain cases. So when we had opportunities to borrow long-term loans at similar pricing, we leveraged taking advantage of the long-term loans available because we wanted to build the long-term loan book as compared to CPs, because CPs are always available, and we will try and bring back CPs to the 10 to 12% levels going forward.
Okay, Mr. Arulselvan, thank you very much indeed for joining us all the way from Singapore, and have a great FY19 second half. Okay, before we wrap up on Bazaar, we come back to the big story.